Welcome back, traders and investors. We have another special guest on the show today, Mark Sebastian. Mark is founder of Options Pit. He's director of trading and investments for Swan Wealth. He's a founder
No,
of,
no, no. I don't work at Swan anymore.
you know,
So just Option Test.
oh, sorry about that. Okay. He's a former member of the Chicago Board Exchange, Options Exchange, and American Stock Exchange. He's the author of the Options Trader Hedge Fund and co-host on the Options Block podcast and Volatility Views. Sorry about that, Mark, but how you doing this morning?
Doing all right. No big deal. Doing great. Looking at the market, and a couple earnings plays went a little awry relative to kind of what the option flow was saying. But aside from that, kind of a good morning, and good trading's not so bad. A little slow, but not so bad.
Well, people are always on talking about their good trades, but you can learn a lot from your bad trades. So, talk about the trade that you had, why you got into it, what factors, and how you're working out of it.
Sure, I got two losers this morning. That I was watching kind of. I'm not the type of guy that sits there and reads through all the tea leaves on an earnings report and says to myself, "Oh, I think." The XYZ company is valued at $72. That's trading 67. So I'm going to buy calls now. What I typically try to do is figure out what I think smart paper is doing. Smart paper is a kind of a professional trader term for kind of not insiders, but the Goldman desk, right?
Yeah,
A guy
exactly.
like me goes out and buys something.
Yep.
I'm just dumb paper, but Goldman's desk is smart paper.
Okay, I agree with that 100%.
Right.
So go on.
So 2 days ago there's some guy out there just buying up through the system sneakily about as many of the Qualcomm September 85 calls that he could get his hands on. So he ended up buying, I want to say something like 15 or 20,000 of the September 85 calls in Qualcomm. And so I said to myself, this guy clearly has an axe to grind, and they've got earnings coming up. And, there's a reason he's picking September. I guess he wants a little extra time. And so I piggybacked him and bought some of the calls. And then in front of it, to just kind of hedge off a little bit of risk, I sold, and to get some real volatility premium, I sold some of the July 85 calls that expire on Friday. And I paid about 50 cents, and this morning it's worth about 7 cents. So not my best trade, but I understand why I did it. Going forward, what I'm going to try and do probably is I'm certainly not going to dump the SEP 85s. I'll probably let the July 85s. I'll buy them back for a penny, or I'll let them expire worthless, and I'll try and find something else to sell.
Okay.
That'll be my plan there.
Okay, so you're obviously taking the loss. Those things are probably worthless now. What you're going to try and do is try and just get some money back. You're probably not going to be able to get back to even, but by continuing to sell calls, you could kind of mitigate the loss on your original position.
Right, and honestly, the SEP 85 calls have 60 days to expire, and they're 7 cents. Why in the world would I sell them?
Yeah, exactly.
I mean, what is the upside value of that? And it was interesting watching Qualcomm after the hours yesterday, because it immediately popped to like 85. That's a big earnings beat, and then they quote unquote guided lower. Some would call it sandbagged, but they guided lower, and that's what drove the stock down.
You could have, and this is hindsight, and I don't know if you use this as part of your strategies, but, with that kind of call position, you could have sold some stock in the open market. Is that a strategy, that you employ, or is just you were just thinking, this was the mother load, and you were just going to cash these things out tomorrow at 90 when it hit?
No,
90?
That's fine. And yes, that is something I've done in the past. With this particular account, that was not something that I could do,
Okay.
that I was trading this in.
Okay.
But yes, I would, if in the after hours when you get a big, huge pop like that, if you have a margin account, or you have an account that can short stock, then absolutely go in and and take a little bit of that market exposure off in the after hours. That absolutely would have done that.
Because 50, you say if you had 15,000 contracts on, I mean, what does that equate to?
Yeah, that wasn't me.
That's
I'm guessing the Goldman guy, whoever that smart customer was, hopefully if he did that, he's actually making a blasted killing this morning. Because the effective straddle that he bought was basically $1.10, and maybe $2, and now it's worth about 8.5. So that would have been a nice trade for him.
Oh, if he had done the straddle. Okay. What was your other
Yeah. Well, if he bought the stock and if he bought the calls and then when it popped, sold the stock.
Oh, yeah. Right. Okay. And what was your other one that didn't work out so well for you?
Another one we saw just kind of all kinds of active paper was in Tractor Supply Company. I know one of your favorites. And not one I follow, but I'm looking at all the activity, and the stuff expiring Friday, they were buying every single put they could buy. And so I said, I'll make a cheap bet. This one was a lot cheaper. It was, both of these were relatively inexpensive bets. I mean, we're talking, 50 cents a spread and 35 cents a spread. And, it looked like Tractor Supply came in line, and it's up a couple bucks on earnings. And, apparently sometimes, and this is one of the dangers you get with call buying and trying to follow along paper, especially in earnings, is that sometimes you don't know what the customer is doing. In this case, it could have been somebody that was long a bunch of Tractor Supply and was protecting himself. That's why, as fun as it is to try and follow paper into earnings, and sometimes it certainly will help you in your decision making over time. Reading paper is much better and much more effective into non-events. So, stuff that raises my eyebrows is somebody comes in and buys a boatload of upside calls in some company and they have 0 events coming up. That can be a good hint, a much better hint that the underlying is going to rally than, a bunch of trades right before earnings.
Yeah, because you don't know if they're hedging. You don't know what they do with the stock. When were you on the floor at the SIBO?
From 2004 till 2009.
Oh, okay. So kind of the tail end of things. And what made you go to the screens, and was it a tough adjustment?
It was a tough adjustment, and they just started. It got to a point where being a local, and it's completely there now, where being kind of an individual local in the equity business is borderline impossible. If you want to trade equities and market make, there are not a lot of places to do it. What I found different about the screen is that when you're a floor market maker, you are so used to paper flow coming to you. So you're used to the orders coming to you and then reacting off of them. When I moved upstairs, I almost felt dyslexic because I was so used to being taking the other side and not generating the order. It took me a little while to kind of figure everything out. But in the end, I'm glad I did.
Yeah, and so if you're not reading the paper that's coming in, what are you basing your trades on? Technical analysis, fundamental analysis? How do you generate your trades?
Volatility. I'm always looking at kind of where's volatility priced and trying to trade them off each other. So generally speaking, I spend a lot of time looking at where volatility levels are. And I try to keep a relatively flat book. So I try to buy stuff when it's really, really cheap, and I try to sell stuff that's expensive. And then I'll use VIX and some of the other ETNs around it to manage some of the bigger risks. So, last week, I'm sitting here looking at Goldman Sachs volatility, GS. And if you want to look at Goldman Sachs vol, the CBO actually puts out a VIX index on Goldman, and it's VXGS. And it basically touched, at the lowest level since before the '08 crisis. So we're talking like 6-7 year lows. And the stock is basically sitting there looking like it's ready to break out. So I put on a butterfly, and by that I mean I sold a butterfly. So I sold the wings and bought the straddle, and that at the 160, 70, 80 fly, and that worked out great. And then against it, I sold. I did a little broken wing trade in international paper that's going to work out. Some stuff in NiSource, and then sold some VIX against it. So I'm always looking at kind of relative value of the options in terms of how much are things moving, what is the risk of them starting to move, and then where is the volatility priced, and I'll make decisions based on that. And this is very market makery of me, but as I build a position, if I'm short a lot of premium, my next short premium trade has to be better than my last one, or I'm not going to do it. And as I'm building more short premium, I'll be a little more lax on certain things to buy. And my goal is to try not have a bunch of systemic risk and to make money off the fact that I'm selling expensive vol and buying cheap vol.
Okay, all right. And so could you just give us what you're on the radar for today? S&P's made a new high, all-time high, pre-market trading, 85.75, and haven't quite hit that yet in the regular session. Actually opened up 2 ticks from the high, intraday high, 83.50, 84. What's on your radar for today?
Well, take a look at, if you're looking at the VIX, we've been watching the spread between the VIX cash and the VIX future, and that spread has been bouncing around from relatively tight to relatively wide, and yesterday closed really wide. So I'm expecting that spread to tighten. So I think there's going to be a little weakness in VIX futures, and I'm expecting the S&P to probably flatline, maybe creep a little higher. The path of least resistance until we get some catalyst for change is going to be up and higher. And I don't think we stop until we get to 2000. And then we'll take maybe a little breather. But, one trait that's been kind of interesting is just, while volatility is low and the VIX is low, that doesn't necessarily mean that things aren't moving. Were you a floor guy? Were you a market maker?
Yeah, I was. Yep. In the S&P 500 futures pit, actually, a few years ahead of you. I'll put it that way.
Yeah, well, it's hard. It's hard to make money in kind of traditional ways, but if you're willing to buy something and let it run, that's worked okay.
Yeah.
There's a lot. The market is slow moving, but it also has a lot of momentum. So, it's the easiest thing in the world to do over the last couple of months has been to buy calls and close your eyes, or buy the market and close your eyes, and it could be scary. And with the VIX this low, I certainly would not just be naked long and unhedged. I mean, I think that'd be kind of silly now, especially with the market approaching 2000. But I think that we're probably just going to continue this path of kind of slow creep higher. It's going to be probably a slow week. They're coming out with Sharknado 2 on July 30th. So I think we're going to have things slow at least until the Sharknado 2 premiere. And then, the 31st, everyone will be hungover from their Sharknado 2 parties. And then hopefully we'll take off into August.
Okay. All right. We've had Mark Sebastian on the line. He is the founder of Options Pit, giving us his strategies in the markets and at a busy time during the open. We appreciate you taking the time out. Certainly like to have you on again.
I'd love to come on.
It was great, Mark. Thank you.
Anytime.
Bye-bye.